What I would like to discuss with you today is a case based on this article. Reuters, December 2023, a court in Amsterdam in the Netherlands on Friday ordered British American Tobacco to pay a fine, not taxes but a fine, of 107 million euros and said it had underdeclared profit by 1.8 billion euros during 2013 to 16 and will owe tax on that. And then it goes on to say by far the largest part of the fines were imposed for an intentional untrue tax claim for the transfer of companies' activities to the UK. And I quote the article because the court case itself is anonymized, but clearly the news outlets here talk about the UK, and we know that it involves the Netherlands. So let's see how much of this case we can deal with. What I find fascinating about this case is it deals with almost everything in transfer pricing. It has guarantee fees, it has factoring, it has intangibles, it has exit taxes, everything. Now, just a bit of background. Here we've got BAT PLC, which is the listed UK company called Company 2 in the court case, I believe, in the UK, Country 6 in the court case, and it holds a Dutch fiscal unity or consolidated group, of which the parent is the taxpayer in this case, referred to as Company 1, and Holland as Country 2. And then we have an overview of the adjustments. You can see for 2013 to 16 an original assessment or adjustment of 11.9 billion euros, of which there is a exit tax of 2.75 billion euros in 2013, some profit splits, some cost adjustments, another exit tax for 14 to 16 of 8.25 billion euros, and then further adjustments in Company 4 and Company 5 for interest, cost plus adjustments, and reorganization adjustments. Now, in the court case, the court scrapped the 2013 exit tax and also the 14-15 exit taxes and only left the 16 taxes for 1.7 billion euros, pretty much arguing that you can only exit once. So let us see how the court has summarized the facts. It refers to a note of the Standing Committee of BAT dated May 2015. Now, I assume the Standing Committee is some high management committee, and it starts with the background. In 2007, Project 2 established a regional structure in Holland of approximately 120 people. Aligned to this organizational structure, an above market trading company for licensed brands was established, Company 3, and that's the one that we're going to be talking about here, covering approximately 20 markets. The proposal is to establish a single Country 6, the UK, trading company to operate as a commercial hub for the region. So not Company 3 anymore. The existing Company 6 supply chain trading entity will operate as a new commercial hub and will be renamed Company 6. And then the trading changes that were going to happen were, with effect from 1st of December 2015, a notice of termination of license rights in Europe for global drive brands and international brands for all markets will be issued on the 1st of June 2015. And then subsequent license rights for the GB international brands to Company 6 will be granted. The entering of standard distribution agreements by Company 6 with all the end markets across Europe, and I think this may have included Company 3. And then the above will be phased as follows. Company 3 markets will be given a 12-month notice and will enter into the distribution agreements effective from 1st of June 2016. And the court goes on to say Appendix 2 of the note to the Standing Committee summarizes the financial impact of the reorganization, as also referred to as the benefit case. And here you can see it shows cash flow benefits from 15 to 22, with overseas tax charges saved of 371 million pounds, whereas the UK tax charges will include by 52 million pounds, so it's a net saving of almost 320 million pounds in taxes. And the court goes on to say an internal presentation held at the 9th of July entitled Corporate Office Staff Meeting stated among other things, the Company 3 export licenses have been terminated. This is not under review. The transfer of our export activities is part of Company 3 project to transfer all business to Company 6, and that is a reference to Project 1. Here is just an overview of that as it looked in the Netherlands in its own annual report of 2016. You can see it has quite a number of subsidiaries in the Netherlands. Most of them are holding companies, but there also seem to be a number of operating companies. And then let's look at the court decision itself, whether there was a reorganization in the sense of Chapter 9 of the transfer pricing guidelines. The court starts by saying, for the rest, the tax authority's position is that contrary to the agreements the claimant concluded with the related parties, it should get an arm's length of consideration for the business transfer by Company 3, right? And that the tax authorities were the defendant in this case. The court holds that such a benefit should be included in the profit. To this end, the court considers, with regard to the situation before Project 1 and Project 2, the following facts have become plausible. And what the court does here is it applies Chapter 9, which says, to understand the reorganization, it is helpful to look at the situation before the reorganization and the situation after the reorganization. Now, the court somewhat confusingly names the first establishment of the Netherlands a Project 2 and then the taking away of the functions Project 1, but let's go through what the court says. This behavior of the group meant, and this is the old situation, right after 2007, that a very large part of the profits from the market served by Company 3 after deduction of, among other things, a profit share for Company 6, which was later adjusted by the court, was deposited with Company 3. In other words, Company 3 got a lot of the residual profit. In 2012 to 14, for example, this amounted to 52 to 62% of the profits. Taken together, these documents show a company that played a pivotal commercial role within the group in exporting tobacco products to more than 20 countries in Western Europe, that bore the associated risk and had the necessary personnel, brands, and rights. So this was a substantial company with a substantial amount of the residual profit. It goes on to say the situation after implementation of Project 1 and Project 2 should then be examined. It is not in dispute between the parties that commercial pivotal function described above was not subsequently performed by Company 3. Management of the distribution companies was now done from Company 6. A comparison of the situation before and after Project 1 and Project 2 constitutes an important indication that Company 3 transferred the part of its business related to the distribution of tobacco products in Western Europe to Company 6. This is confirmed by internal presentations of 9 and 14 July. And again, there's a number of internal documents that the court looks at which mentions that there is a transfer of a business, right? Even though the taxpayer argued that there is not. It can further be deduced from the base case that in financial terms, only a tax benefit was expected from the centralization, namely a reduction of the overseas tax charge that would be many times higher than the increase of the UK tax charge. Now, to be fair, the internal documentation do mention other benefits as well. There is a shortening of communication lines, a streamlining of functions, etc., etc. But the court focuses on the numerics. And if you look further at the table that I showed you, the table does show some other financial benefits regarding shortening of lines, etc. But they are far less than the tax savings. This assumes that the transfer of the profit potential associated with activities, functions, and risks was also among the main objectives of the reorganization. Is what the court says. And then it says the claimant objects that Company 3 did not transfer any balance sheet items to Company 6, and that the relevant team in Company 3 left that concern, all but one. Therefore, a transfer cannot be said to have taken place. And this is the interesting part of this discussion, right? Is the mere termination of license agreements, can that lead to a business reorganization under Chapter 9? Because the termination clauses in the license agreements were at arm's length, and terminating those license agreements were at arm's length, right? But the court says, however, this does not alter the fact that the aforementioned activities, functions, and risks of Company 3 and the associated profit potential were transferred to Company 6. The latter is also evident from the base case, which mentions income brought into Country 6 and profits being moved. The court considers the fact that the agreements concluded by Company 3 with group companies were not taken over by Company 6, but were terminated and subsequently re-entered into by Company 6 to be of minor importance. And of course, in substance, this is exactly the same thing, right? These legal acts were carried out as part of the transfer of functions and risks referred to above and were subservient to it. They were therefore part of a coherent set of legal acts aimed at the transfer of business activities from Company 3 to Company 6. This entails that the court rejects the plaintiff's view, which characterized the execution of Project 1 and Project 2 vis-à-vis Company 3 as only a matter of contract cancellation, not because this view is in itself incorrect, but because it is selective. Indeed, the claimant overlooks the context in which the termination of the contracts took place, namely the centralization of business processes in Company 6. So the court concludes there has been a reorg, and now the question is, how much should Company 3 be compensated for this reorg? And the court says the plaintiff argued that the profit earned during the extended notice period for the license contracts should be considered as remuneration. The court does not go along with this. So what the taxpayer said is, you know what, we gave a termination period of 1 year. That money earned during that year is compensation for terminating the contract, right? And that is a commercial argument which any licensor cancelling a license would make vis-a-vis a licensee. But the court does not agree. It says, first of all, it is not clear that from the documents relating to the termination of the TMTTAA, which I assume is a termination, that the notice period was intended as compensation. The documents don't say so. Nor is it obvious, since the income enjoyed by Company 3 during this period resulted from the continuation of its business activities, in which it also bore the associated risks, and constituted the remuneration for those activities. Moreover, according to the parties, Company 3 also paid an arm's length fee for the license rights during the period. So what the court says is, you know, this 1 year is not a compensation. First of all, Company 3 still had to do the work, and it still had to bear the risks. And that's what it got the money for, right? And besides that, out of that money, it paid a license fee for using the brands. And the license fee was the same as the license fees in the years before. And if the license fee during the years before were at arm's length, then the license fee during the last year is also at arm's length and is not a compensation for the reorganization. The court goes on to say the tax authorities calculated the fair value of the company using projected cash flows. And now we get into how the court comes to the 1.7 billion. And it's a general process. There's nothing special, but it's nice to see a court actually going through the different steps. And the tax authorities started with the future cash flows, which it discounted. In the court's opinion, the use of this method is reasonable. It will then be necessary to assess which cash flows can be assumed and at which discount rate they should be discounted. This makes sense. So the court starts with the starting point of the estimate of future cash flows interfaces with the calculations in Annex 2 and 3 of the Huygens Quantitative Consulting Report dated 21 June 2023, which said that the average cash flow was 70.4 million per year on average. And the fact that it's 23 indicates that the report might have been made in connection with this case. And it then goes on to say the projection in the base case assume that profits will remain the same in the years 16 to 22, so that will be business as usual. The defendant also assumed, as the defendant is the tax authorities. Therefore, the court sees no reason to assume movements in the eligible cash flows to be considered. Okay, so the court says we'll just assume that 70 million will continue. The court also follows the tax authorities' argument that the profit should include the other adjustments made because these were not at arm's length and they should be at arm's length, right? After all, an independent buyer will assume that it will have to enter into the relevant transactions after the acquisition at arm's length prices. Hereafter, the court concludes that the adjustments for Company 6 fees and the IT royalties were upheld. So what the court says is, you know, if you pay too much for Company 6 fees and if you pay too much for INT royalties, then we need to reduce those prices when we calculate the value of the company. And it says the total adjustment is 64.6 million on an annual basis. Assuming a 25% corporate tax, the adjustment comes to 48.4 million. This brings the total cash flows to be taken into account the 70.4 million from business activities and then the other 48.5 million for adjustments, for TP adjustments were payments which were not made at arm's length in the past. And that brings us into almost 119 million euros. And what I like also what the court does here is it says, you know, when you look at the future income streams, you also have to deduct the taxes, right? So yes, the adjustments are for 64, but if you get 64 more in tax, in income, you're going to pay 25% tax on that in Holland. So you only have 48 left, and we'll take your 48 after tax and multiply that with a discount factor to figure out what the adjustment should be. And then in the next line it says the benefits resulting from the centralization are discounted at 6.5% in the base case. The court sees this as an indication that the 7% discount rate used by the defendant, the tax authorities, which is equal to the average cost of capital from the group's financial statements, is too high rather than too low. Now remember, when you take your future cash flows, you deduct from that your discount factor. So uncertainties, inflation, etc., etc. So the higher the discount factor, the lower your future cash flows will be, right? Which is why the court says that the 7% used by the tax authorities is more conservative than the 6.5% used in the base case. And then the court says, based on the foregoing, the court considers it plausible that an independent third party would be willing to pay an amount of 118 million multiplied by 100 divided by 7, that's your discount factor, 1.7 billion for the company of company 3. Given the many uncertainties inherent in a valuation such as this, the court rounds this number in the claimant's favor to 1.7 billion, dropping another 414,000 in taxable income. Now, this is what the court values the company at, or in other words, the exit tax. But then it also says, now we need to apply Dutch transfer pricing rules, right? So finally, it must be assessed whether the conditions for establishing a profit distribution have been met in respect of the transfer of company 3's business. In other words, was there a distribution or did you get paid for it? The court finds that these requirements have been met by transferring its valuable business to company 6 without any consideration. Company 3 conferred a very substantial advantage on it. And then the court just adds another tale, but I think is an interesting one worth mentioning. It says the 2015 opinion of Advisor 9 describes in detail that reorganization such as this one may result in a transfer that should be subject to an arm's length consideration. However, according to Advisor 9, this is not the case in the proposed reorganization, partly because technically, and I love the brackets being used there, no assets or functions have been transferred. The same argument what the taxpayer made earlier, right? On that basis, the analysis is limited to the question of whether the termination of the licenses was at arm's length. And again, the court just shoots the start and says, this demonstrates too narrow a view of the complex of facts, which in all reasonable were known to the plaintiff. And because the plaintiff should have known this is why they get these 107 million in penalties, right? In addition, the claimant's internal presentations cited above also expressly refer to a transfer. And I will end with this. What I find interesting about this case is it also reminds me of the DSG case, the Dixons case in the UK, where Dixons UK sold white goods to customers who then bought a third-party insurance for those goods, and then the third-party insurer reinsured those insurances with Dixons and Bermuda. And the tax authority said there is a transfer pricing adjustment that needs to be made here because Dixons UK gave a large benefit to Dixons Bermuda for overpricing all these insurance premiums, which Dixons Bermuda could only realize through access to Dixons UK's customers, right? And Dixons said, but this is nonsense. I mean, you've got customers, third parties, buying insurance from a third-party insurer, which is also a third party. So what are you talking about? But the court there too said you need to collapse the whole transaction and you need to see it as one big whole, like the lower court in the Netherlands has seen here. I look forward to discussing the rest of this case with you in subsequent videos in which we will look at guarantee fees and intangibles and the like. Bye for now.